Stay tuned for a special edition of the Multifamily Deal Lab podcast. Welcome to the Multifamily Deal Lab podcast, where we dissect a deal before your eyes and ears so you can discover the strategies and tactics that got each deal to the finish line. Strategies and tactics that you can put in your own toolbox to get you to the closing table. From sourcing the deal, raising, due diligence to the property takeover, Multifamily Deal Lab shows how you too can get the deal done. And now here's your host, David Lindahl.
Everybody, welcome to Multifamily Deal Lab. I'm your host, Dave Lindahl. Hope everybody's doing well. I thought I would bring on Scott Stafford. Scott, many of you know, he's been a student for many, many years now. He's been part of just about all of our groups, coaching, Elevate, L Society, and he created a product called REI Indicator that actually goes through the demographics of all the major cities, secondary markets, and tertiary cities throughout the U.S. But anyways, I thought I'd bring Scott on because we were chatting the other day, and he was talking about, one of the opportunities that's going to be on the backside of this pandemic. So Scott, you with me?
I am here.
Let's take the first question. First caller.
Hey, Dave, and hey, Scott, thanks so much. We really appreciate all your guidance through all of this. My question has to do with the stimulus, and, there's a wonderful and massive amount of stimulus trying to keep, liquidity flowing through a seizing up economy as we basically are turning it off. But I'm just curious. There's always pay me now, pay me later kind of puzzles when you're in situations like this. And I'm just curious about your opinion and what you're hearing from experts as it relates to mid to long-term inflationary pressures resulting from this sudden inflow of cash.
Scott, you want to take that first?
Sure. What I've been hearing, and there's just an enormous amount of conversation on this topic, and nearly everybody I've been able to tap into myself says basically we don't know until we get there because it is sort of a different situation. But the ones I've been following most closely for a longer period of time and have a better sense of where they're coming from suggest that just because of the nature and the mechanisms that are being used, it shouldn't be highly inflationary. We probably won't go into a time of rapid price increases. And in fact, there's even some thought that there might be a deflationary pressure going on now too, because demand is just so low. I did see people are they're buying single family houses almost at the same rate still. They're going on virtual tours, they're putting in offers. I think the thing we don't know is how quickly we can get this behind us. So we don't know how much more money needs to be dumped into the economy and what mechanisms need to be used to do that. If people are just holding their breath and holding on for a very long time, there will be a pent-up demand so long as they have a new job or a return to their current job to actually buy things. And that's when inflation might start to kick in. But I don't see it in the next 6 to 9 months from what I've been reading.
Yeah, I'll have to concur with that. Because I haven't really been focusing on that aspect of the economy, the inflationary aspect. I've been focusing on the recovery, the real estate market, and actually what the pandemic has been doing right now. So Scott's a lot more in tune with that question. That's a pretty good question to start off with, pretty in depth. But the surprising thing is that, there's a lot of people out there still looking for single family houses and they're putting them under contract. I was surprised to see that part of information to come over. And actually I have a family member that just put a single family house under contract yesterday and sent it over. Nice house. I congratulated him. But in the back of my mind, I thought, wow, maybe in like 2 or 3 months, that market's going to really take a hit, and that property could have been gotten at a much lesser price. Although I didn't want to tell him that because he was so happy about the house that he just got. He's in the military. So he's in a situation where he needs to move. So it is interesting how different aspects of the economy are being affected by this, and some of them that aren't. Thanks, Kim. Next question.
All right, Dave. Next question is from Chad. Chad, you're on with Dave and Scott.
Thanks, Dave and Scott, for doing this today. I guess it's a simple question, but, and out of an abundance of caution, we've been looking at all avenues for making sure we maintain adequate liquidity on properties that we're currently operating. And part of that has been this whole mortgage deferral program that Fannie and Freddie has been rolling out. We're not in a position to need that as of now, but we're really trying to understand it. And I've been getting some mixed information from the different servicers. I guess my question is your team considering doing that on any of your properties? And if not, what are the major deterrents that are pushing you away from it? Just really trying to understand that.
We've got one property that we're looking at may go in that direction. We're running at about 87% occupancy. I think it's 82% economic. So before the pandemic happened, that property was struggling a little bit anyways. So we needed to change out the management company. So we're watching that one closely. On the other properties, the rents have come in strong. So far, so good. But that particular program, it's basically, you get, as of now, it's 3 months deferment, and then you have to work out a payback plan, typically within the next 12 months, on how you're going to pay that back. And then I think it was Fannie Mae's program pretty much states that if you get any type of assistance whatsoever for the property, that payback gets paid first before you pay anybody else.
Yeah. Did you see any information about, I guess this is what's got me worried. I know you have to make sure you're adhering to the eviction moratorium during, the federal period as well as during the 3-month deferment. I've seen some buzz that during that 12-month or so repayment period, you also have to extend your eviction moratorium, which kind of is a dangerous thing as an owner. Yeah. Have you heard that at all?
Yeah, I have. Oh, you know what? Now that you say that, I'll get clarification as well. Because I read it as that while you were paying that money back, you couldn't evict. But that doesn't make any sense.
It doesn't. And that's a terrifying thing as an owner because people talk. And if you're 12 months with an eviction moratorium, it's a big deal, right? So,
yeah, I'll get clarification on that. Jermaine, I know you're on the line. Any chance of calling Eric Stewart and getting clarification on that while we're still on this call? That would be great.
So no problem.
We'll see if Jermaine can get that answer to that question while we're still on the call today. If not, we'll send it out.
Okay, thank you.
Yeah, thanks, Chad.
So I have Robert Zamina. He writes to Scott, what do you think of the Tulsa and Oklahoma City markets? Are they too energy dependent?
In my opinion, they are. I think if you live there and you can find that distressed seller and or distressed asset, and you get the opportunity to be very careful reviewing what's the tenant base, where is it in the market, you might be able to do okay. But I would be nervous myself in markets that are so energy dependent. I think maybe Tulsa will have a little bit easier time with this than OKC.
All right. I have another one that was emailed in. This one's from Michael DeRosa. He writes, Dave and Scott, how will college towns do? Is there a chance the universities won't open next school year?
Because the infrastructure with Zoom and other things have been built out so strongly and are being used intensively now, this ties into the idea of which markets are overexposed. There are a number of very wonderful tertiary markets that their major dominant industry is colleges and universities. You definitely want to be very careful in those markets because long-term, we may see a shift. This may be permanent in the way we deliver college level education. It may be the one clear fundamental shift that's before us right now would be how we deliver education.
Yes. I recently took a class over at Harvard on innovation. It was a 1-week class through their executive program. And one of the things that they talked about was the fact that their MBA program, they can, I think, administer to 400 and some odd students. And then it's capped. They cannot sell any more into it. But their online program, that's their fastest growing program. And they can catch people from all around the world. And their revenues don't really have a ceiling. And so I think, and for an example, I put 4 of our executives over here. It's called HBX Core, and anybody that's listening can go through it. It's pretty rigorous, 17 weeks. It's an online class. There's a test every Thursday, and 4 of us took it. It's all about accounting, economics, and analytics. And you can take each one of those individually if you want, but we decided to go through the 4. There must have been about anywhere between 400 to 500 people in our class from all around the world, which is pretty cool because inside of their online classes, they have discussions. So you could be discussing with somebody from somewhere else. But they were saying that, their campus is limited while their online is unlimited. And I think a lot of the colleges in higher education now realize that, and most of them are going to online curriculum. Now, especially with this pandemic going through, I think that shift could be one of those shifts that when I was over at Harvard and I took the OPM program, We basically went to class for 6 weeks, and then they taught us business models, and then we went out and used those business models for eight or 9 months. Then we came back for another 6 weeks and learned the next set of business models, and went out and used them and did that one more time. That may be where higher education is headed. So you want to take a look at that. So in thinking about that, in a down economy, typically student housing has always been one of the best resources, or actually one of the best performing types of properties. Apartments always outperform all other commercial in a down market, and then student housing always outperformed all of the multifamily sectors. So now you got to take a look at it, and you've got to kind of wait till the weeds kind of get out of the way so you can determine how this effect is going to hold up on these student housing deals. So it's almost like the military. You never want to go into a military town and have more than 10% military inside of your property, because those people can be sent somewhere else in a very short period of time, overnight. So the risk is there. So now you got to start taking a look at college campuses and college towns the same way, student housing.
And we have a generation of kids that have been growing up learning online with YouTube and various other free resources, and they're going to be thinking that they can handle an online education much more freely than we did. In terms of, when I go back to school, I prefer to be in a classroom. It's what I know. But, the new generation, that's not what they know.
Yep.
I believe Chad had another question.
Yeah, thanks, guys. I didn't know I'd come around that quick again. So general strategy question, Dave. I mean, we're unfortunately in the middle of a very good acquisition at this point, and we were involved. We were 10 days from close when the debt market seized up and wound up having to pivot on the lender and renegotiate. So it's been kind of a fun couple of weeks to figure that out. But that being said, it is about 67 units of workforce Class C vintage apartments. The exteriors and structure and all that's great. We've already been through all that. It's all heavy interior turns though to get it up to where we need it to be to support the Class B tenant base in the area, right? So my question is, going into this, we're definitely in the position right now where we're going in well funded and well capitalized, and we'll be holding on to money and kind of riding this out. But we've really been back and forth on, okay, do we simply try to ride it out with the existing tenant base that we have and just deal with whatever economic vacancy comes our way because of, as you said, wage earners being impacted by the economy? Or once we get through the other side of the moratorium on this, if we're still having a lot of trouble with it, do we start pushing forward and actually trying to spend the money required on the units and put I guess the right term is a more stable tenant in there who's likely to be salaried and less impacted by the situation? So it's kind of one of those, I could see an angle both ways. I'm just curious what your thoughts are. I know there's not one right answer, but what are your thoughts on that?
Are you saying that you have a C+ property that you can turn into a B-?
Effectively, yes.
Yeah, that's
and that's the business plan that we originally had, but now we kind of pivoted and like, okay, we're going to go in with cash in the bank and ride this out. But is that the right decision, in this situation? That's what we're trying to figure out.
I would certainly ride out the next couple of months for sure.
Yeah.
I think your business plan is probably just right for this type of scenario because of the fact that you had vacancies within inside that business plan. You had turnover inside that business plan. And you're putting in a more stable tenant that's not going to be as affected by these swings in the service sector. The hardest thing is you don't know what's going to happen in the 2 months. Do you know what I mean? You don't know how many of those reserves you're going to need to dip into in order to get through the next 2 months or 3,
Yeah, so it seems like maybe we kind of ride out the next, once we actually close, we've extended to close no later than June 22nd, which gives us the ability to ride it out with the seller controlling it, and he has no debt on the property, so that's kind of good. But
you have money hard on the deal?
I do, yes.
At least you'll have a decision, going into the deal. That's going to be plenty of time. You should have clear vision at that particular point as to exactly what you're getting into.
Yeah, it's much better than we were. We were hard money with a lender that walked away 10 days before close and a contract that was expiring April 21st. So we're in better shape now. But
let's, hold on, Chad. Let's unmute Eric at the same time. There he is.
Hey, guys.
Hey, Eric. So you just heard Chad's scenario. What would you do in that situation? What do you think about that?
I didn't hear the whole thing. Are you talking about taking this opportunity to improve the units?
Yeah, he's got a C+ property that his business plan was to improve the units. He's got a bunch of money that I'll have in the bank ready to go, improve the units and put a B- tenant in there and turn the property up. But
yes.
Of course, he's concerned about what's going to happen over the next couple of months, but he doesn't close until June 22nd. So we'll actually be able to see that. What do you think?
I think he's in a phenomenal position, frankly, because he's got the luxury of time and discovery. Apparently, you'd mentioned you're already pregnant in deal. So, from that point, you are committed, but you got the luxury of time to be able to see what's going to happen and try and get some stability of knowing what's going on. Do you take the opportunity to improve the asset when you have the money available? And hopefully you're going to have a rejuvenated labor force, people wanting to get back to work as well. My opinion is yes. Taking that opportunity to improve it now and being able to increase rents, as long as you guys were earlier, you were talking about the forbearance period and whatnot. Not in this case, but in other cases, you may not be able to raise rents. In this scenario, I think you've got, the opportunity to do that. You've got to watch the competition though. If all the surrounding properties are in that forbearance period where they're negotiating with tenants and tenants are on this limited rent bump structure, your competition may be tough to be able to get those units filled at the higher rents. So I guess I would keep that in mind. But as far as improving the assets, yes, that's something I think you would take this opportunity to knock that out right away.
That's a good point about, where rents are going to be at the backside of this as well. It could be a lot different than what you had predicted. I like the idea of improving now and being ready for the summer, because there's going to be transitions in the summer, and then there may be the risk of this thing coming back in the fall and people may not be moving as much. So you at least capture the market,
Perhaps we could thread the needle. So, okay, thank you.
I have noted a couple of cities are kicking around possible temporary rent ceilings, rent raise percentages to hold markets a little more stable for renters. So I would just add to the mix, find out what's going on in that market. Be aware of what may be coming on that.
Which cities are those? Do you remember? Do you recall?
I know that Washington, D.C. as a city is entertaining that. And I believe a market in the Midwest was also looking at that. So what we're seeing here as this evolves and unfolds, the nature of the impact gets more severe until we turn the tide. So people will be looking for ways to alleviate the challenge to the tenants, and that's through legislation, through temporary measures from city halls. So, and then of course there could be courts involved, and the state may come in and say you can't do that. Who knows? But I'd rather just at least know whether or not that's rumbling around in my city or state.
Good point. Eric, Chad had a question regarding if you take the deferment of the 3 months rent from Freddie Mac, Fannie Mae, and you cannot evict during that period, then you have 12 months to pay it back. Can you still not evict during that 12 months, or is that eviction moratorium over after the 3 months?
It's a great question, Chad. And when I read the forbearance terms, I had that same question because there's a caveat in there that says during the actual forbearance period, right? Mm-hmm. The terminology is the months of actual payment forbearance, right? That was a question I had, and I sent it into 2 servicers, and I'm waiting for a response on that right now. So great question. I'm glad you caught that as well. And not only does that apply to evictions, but it also applies to you being able to make distributions to your investors. And I think that's, yes, you're going to have to evict people. You want to work through those few tenants, hopefully few tenants, but also consider, guys, the ramifications of you being able to distribute to investors, possibly for that 12 months. And also it's very similar to a lockbox where they want to capture all of your excess cash flow. So really have to find that out, and I'll make sure to report back to Dave. And as soon as I get an answer or anybody else gets an answer, sharing it with the group would be incredibly valuable there. A definitive answer. But not only does it apply to evictions, guys, it applies to distributions to your investors, which is a huge component to this.
That's interesting. I didn't realize that was part of it as well.
Yeah, I mean, if they've given you a break on payments, and you're in the process of paying that back, just from a lender's mindset, the last thing they're going to do is allow you to pay your investors a profit, Yeah,
that makes sense. That makes sense because Fannie Mae has that in their particular plan where if you get any type of funding from any source, they get paid first. So it makes sense that they would get paid before your investors get paid as well. All right. Do you have any additional updates? Has anything else changed in the last week or so, 2 weeks, in terms of lending requirements?
What I've seen that was most interesting to me was and I'm sure everybody's familiar with the reserve requirements that we're seeing in place, that we've seen implemented, both Fannie Mae and Freddie Mac. And I think it's really interesting to note where the most restrictive terms are, which are on the smaller balance deals. By that, I mean either an 18-month principal and interest reserve from Fannie Mae, and Fannie's also reserving for taxes, reserving for insurance, and also replacement reserves above and beyond what they normally do. Freddie Mac is a little bit more lenient with only 12 months in standard reserves, but Freddie's capital markets execution program, their conventional program, is on a debt service coverage ratio reserve structure. So that to me is a big tell on.
Explain what a debt coverage ratio reserve structure is for everybody that doesn't quite understand that.
My apologies. The benchmark here is if the lender can underwrite to a 1.4 debt service coverage ratio or better, they're only going to require 6 months worth of mortgage principal and interest reserves. If it's 1.4 or lower, then they're going to require 9 months worth of principal and interest reserves. Realistically, and relative to what everybody else is doing, that's not too bad, because the way I read the whole reaction with Fannie Mae and Freddie Mac is very bullish to me. It's very positive. And I say that because they didn't ratchet back their overall leverage, right? They didn't come out and say, Mr. and Mrs. Investor, we're scared to death, and we're going to slice all of our leverage by 15%. If you want 65%, we'll do it. They didn't say that, right? All they said, look, we're going to lend you our standard terms, and we're going to marry up to you for the next 7, 10, 15 years with our standard programs. We just want a little bit of extra security here for the first year, maybe year and a half, and then we'll give it back to you, right? So your investors, you're going to have this reserve in place for 12 months, but then you're going to offer your investors a capital event. And if all goes well, you're going to return that money to them, and it's really going to help your IRR. So in your underwriting analysis, make sure that you plan for that capital event, for that reserve to go back to your investors, and see what that does to your IRR. I see it, and I read into that as a short-term defense mechanism, but a long-term, they're still very much in the game. That's the way I read it.
Mm-hmm. That's a good point. Excellent analysis. Thank you. Stay with us. So we have a few more minutes left. Jermaine, do you have anybody that is calling in?
I have another question from Kim. Kim, you're on again.
Hey, Kim.
Hey, thank you so much. By the way, this has just been a great conversation. I'm really grateful for it. Regarding deals in progress, we literally are part of a team that just closed a deal like the week before everything fell apart.
Congratulations.
So, yeah, right. So we have a C property in a C area. You know, it was going to be a minor reposition, mostly management reposition. The reason we were excited about it is because it's in Atlanta, in a path of progress where hundreds of millions of dollars are being spent revitalizing the area. So we still had some fundraising to do. For a complicated reason I won't get into here. We are planning to also get certified for Section 8 HUD, because in Atlanta, there were recently 300 HUD doors made available and over 36,000 applicants. So we know there is a strong demand for Section 8 subsidized housing. So that's a part of the plan already. So what I'm curious about is, as we're going about this conversation to talk with investors about getting into a deal now that's already closed and so forth, do you think the location sell is strong enough when combined with the Section 8 plans where we can increase rents as is? And do you still think Atlanta is a strong market?
First of all, how many units is that deal?
It's small. It's 36 units.
All right. And you said it was a C property in a C area. You've got to be prepared. If you're going to introduce Section 8 into a property like that, you've got to be prepared for a mass exodus, the possibility of a mass exodus when people realize that Section 8 tenants are coming into the property. And I only know this from experience because I did it down in Alabama, one of the first larger properties I bought. And just the people that, they weren't happy with Section 8 coming in. So you've got to weigh that risk. Are you getting a higher rent from the Section 8 tenants?
Yeah, we will, because it's so dramatically below market right now.
The rents are below market?
Yes. So the theory, I'm sorry.
Bring those rents to market, are they going to be equal? Are they going to be less than what Section 8 would be paying you?
They should be equivalent. However, part of the uncertainty right now is that in order to have a property considered, they have to be able to go in, and in Corona-mageddon, that's going to violate social distancing. So we're delayed knowing for sure what the possible upside is. However, our experience with Section 8 and other areas of the town show that it would be either at or slightly below what the market is.
So what do you think the benefits are by transitioning over to Section 8?
Just the assurity of rental income, especially where we have a large percentage of the population that are completely affected by unemployment right now as they're wage earners. And so Section 8 would just, help make sure some rent's coming in all the time.
I can understand that. It's going to be a risky move. Just want to tell you that, because you will have a lot of people leaving once Section 8 starts coming in. So you're going to, if there's a big backlog, as you said, of applicants for Section 8, you may be able to fill it very quickly. But I think you're going to go through a few months where, you're going to have a lot of people just leaving.
Okay.
Eric, do you have any opinion on that? Scott?
We've actually implemented some subsidized housing on one of our properties, and it's turned out to be a real benefit. We started with participating in the VASH program, and I think that may have been a more subtle entry into the subsidized housing arena, because again, you're working with veterans. What I've learned and what I was told initially is, just because somebody's a vet doesn't necessarily mean, it's not automatic sainthood. They're in the program because they're working through some issues. So you want to be prepared to work with their guidance person. But that was a kind of a more subtle transition, and it may benefit you. It may be helpful. And now we've transitioned to about 45% subsidized housing, and it's worked out real well. It did task us, though, if the property's already all bills paid, it tasks us, to do a deeper dive into our expense ratio, because now we're getting subsidized for utilities. We're taking that over. So we have to work on our cost savings. So that's just another area that I've found to be beneficial.
Scott, any opinion?
Yeah, we've seen historically that Atlanta is one of the markets that's a lot more volatile than some of the other majors. It tends to spike up higher and fall faster. And the softer neighborhoods, the weaker elements get hit very hard. So my question would be, what's the competition and how long do you expect to hold the property? So if you're going to shift mostly to Section 8 and you expect to do it mid and long term, and you're not really concerned about trying to prove value to another buyer in 2 or 3 years because the neighboring properties may suffer negative consequences because of the market downturn and the neighborhood struggles, then by all means. But if you were expecting to get out quickly and value add quickly with the Section 8, I think you might want to be more cautious on that.
And you want to answer a question as to the strength of the Atlanta market or the possible comeback at the backside of this?
I really like Atlanta in ways I didn't say 5 or 7 years ago. They have diversified their economy significantly, and I think it has a much better shot of not having the delayed recovery that it did in 2008. So generally speaking, I'm much more optimistic about Atlanta than I would be in any other recovery mode.
Anybody else on the line?
There are some people who email some questions. I don't know if you have time for that, but
yeah. Why don't you do that? But before I do that, Scott, why don't you plug your REI indicator, and then Eric, why don't you give out your contact information, because both of these guys we use as a resource on a regular basis over here at RE Mentor and in our investing. So yeah, Scott, you go first.
RE indicator is, as Dave mentioned earlier, a way to classify your neighborhoods so that when somebody says it's a C neighborhood, based on data, not a speculation. It also tracks the emerging markets, and we're building in a market cycles module as well. And it's got a whole bunch of new capabilities that are in the works right now. Just had a call yesterday on some data issues and some programming issues. We continue to build it out, and there's a tremendous amount of resource that comes with it. including videos about how the market changes. I take you out in the field. You can learn from me by showing you how neighborhoods change. So hopefully you'll have an interest in adding it to your toolbox if you don't already have it.
Where do they go? ariaindicator.com. Where do they find more information?
They can go to info.ariaindicator.com, and they can also talk to folks at your office.
So if they had questions directly to you, they would go to info@ariaindicator.com.
Right. If you have a question directly to me about something, you can send me an email at scott@ariaindicator.com.
All right. And Eric, give out your contact information. You are a great lender, and you've been servicing us for years.
Thanks, Dave. I appreciate the opportunity. Eric Stewart, Atlantic Business Capital, and my phone number is 800-916-9005. 800-916-9005.
If you're in the middle of navigating a deal and you need some advice, give Eric a call. What happened to Chad, if all of a sudden you lose your lender 10 days before the deal because what's happening, give Eric a call because he has a portfolio of lenders that he has available. And what else were you going to say, Eric?
But yeah, my email address is first initial, last name. So it's estewart@atlanticbusinesscapital.com. And thanks for the kind words, Dave. I appreciate that.
All right. So yeah, well, we'll take a couple of questions right now. If you guys want to stay on the line, feel free. If you guys have got things to do, Scott and Eric, feel free to drop off too. It's up to you.
So I got a question that was written in by Gene Nicholas. He writes, given the current situation, what should our Trinity criteria be for the respective Class A, Class B, Class C properties?
The Trinity is always the same, regardless of the property type. You want to hit, for those that aren't familiar with the Trinity, you want to hit a cap rate of probably 7.5 plus, a cash on cash return of 12 plus, and then a debt coverage ratio of 1.6. So when those three come together, then you've got enough cash flow in the property and a solid enough deal where you can go out and raise money to fund that deal. So it doesn't matter what the markets are doing and how they're changing, what cycle they're in, the Trinity always remains the same.
Another one from Joan Urquhart. This is probably more for Eric. Is interest rates, are they going up on commercial and multifamilies, even though the rates are low?
To answer your question, yes, we are seeing increased rates right now because of the volatility. When there's uncertainty in the market, when there's volatility in the market, lenders get a little spooked, right? A lot spooked. So that's when they increase their spreads to try and make up for any of that volatility. Even though treasuries are low, agencies have actually implemented floor indexes, meaning even though you see a 10-year treasury yield at 0.75 or 0.8%, they're not going to go any lower than 1.1. So yes, they are. We've seen some increased pricing, still historically low, but we have seen increased pricing, and I wouldn't expect that to line out until we start to gain some footing and some direction going forward with the economy.
More, Dave. We have one from Matt Maupin. He writes, I'm curious, what percentage of rent collections have been affected by COVID-19 in everyone's portfolio?
It's too early to tell right now because we're only in day 7 of April, but it all depends on it's all property specific. Like I said, in our portfolio, we have one difficult property that we're concerned about. But other than that, the rest are doing okay. I think you'll see more risk in the C properties than you will in the Bs and the As. So we can report more mid-month and at the end of the month as to what happened this month in terms of rent collections and revenues.
And the last question for the day is from Nadine Simmons. She writes, has the government ever decreased the rents on VA vouchers?
Geez, I don't know. Eric, do you know the answer to that question? Scott, do you know the answer to that question? Has the government ever reduced the rent on VA vouchers?
It's always been a cost of living index for us, which has increased over the years or since I've been managing it. So I haven't seen a decrease. All
right. And one more just got written in is from Steve Knowles. He writes, what do you think of transitioning student housing into housing for middle income retirees who are still physically viable?
I wouldn't do it just yet. I'd see how this shakes out, but it certainly is an option because that demographic is rising faster than any other. So I just it's kind of like a wait and see. All right. Well, I want to thank Scott for coming on and giving some great information. I want to thank Eric for coming on and giving some great information. And everybody out there, stay safe. We'll be back next week. We'll keep you advised as to what's going on in the marketplace. Remember, this is the time to be sharpening your tools, to be prepared for the opportunity that is just around the corner at this point. So work on those things that you're a little weak at. Work on strengthening your team. Work on your property. If you're an operator right now, daily focus on your property. And we'll see you all next week. Bye, everybody.
You've been listening to the Multifamily Deal Lab podcast, where the deals get done. If you'd like to learn more, visit davesfreebook.com. And don't forget to leave a 5-star rating and review, and hit that subscribe button so you don't miss an episode. Thanks for listening.